So, India's economy is posting some absolutely incredible numbers lately. But what if I told you the real story is, well, a lot more complicated? A new report from Deutsche Bank really pulls back the curtain on this economic paradox, and today we're going to unravel it together. All right, let's just start with the headline number, because it's a big one. For the third quarter of 2025, India's real GDP growth is forecasted to hit a massive 7.7%. I mean, in a world where most economies are hitting the brakes, that is an absolutely stellar figure. And hey, it's not just us saying it. Deutsche Bank themselves confirm it, saying growth is likely to come in strong once again. So on the surface, this looks like a pretty straightforward success story, right? An economic engine just firing on all cylinders. But here is the all-important question. Is that really the whole story? Because, whenever you start to peel back the layers on these big, flashy economic numbers, you almost always find a more complex and, frankly, a much more interesting story hiding underneath. And that brings us right to the heart of the puzzle for this explainer. This really strange gap between what we call real and nominal growth. It's a paradox that gets to the very core of what's actually happening in India's economy right now. Okay, this is where that paradox really comes into focus. On one hand, you've got that huge 7.7% real GDP growth. Think of that as the economy's actual buying power. But then you look at the nominal GDP growth, the economy's gross salary, and it's only 8.6%. Now, that's the lowest it's been since the pandemic, and the gap between these two numbers is, well, it's surprisingly small. Which leads us to this key question. I mean, how is that even possible? How can your buying power be surging ahead when your actual salary is barely growing? It doesn't quite add up, does it? So to solve this little mystery, we have to look at the hidden number that connects these two. It's something the report points to as a kind of inflation illusion. The answer, it turns out, lies with a metric that most people don't really talk about. It's called the GDP deflator, and it's the secret ingredient economists use to account for inflation. You basically take the nominal salary, you subtract the deflator, and poof, you get the real buying power. And here it is. Here's the answer. The GDP deflator is incredibly low, just 0.9%. So when you subtract such a tiny inflation number, it makes that real growth figure look absolutely massive. In fact, the Deutsche Bank report itself says this low deflator artificially props up the real GDP number. And just like that, the puzzle is solved. So, okay, with that statistical mystery out of the way, let's look past the numbers for a second and see what's actually powering the economy on the ground. What's working and what isn't. The report really points to two key pillars that are holding everything up. First, private consumption. That's you and me out there buying things. That's strong. Second, public investment. We're talking government spending on big infrastructure projects. That's also really strong. So what's the weak link? Well, it's the private companies. They're holding back on their own investments, mostly because of all this uncertainty in the global economy. And that government spending, it isn't just a minor factor. It's a huge one. I mean, just look at this chart. You can see a clear, powerful surge in capital spending year after year. Right now, this public spending is a super critical pillar supporting the entire economy. But this also makes you wonder, what happens if that spending has to slow down? So this whole complex picture, strong but statistically boosted growth that's super reliant on government spending, it naturally leads to questions about what's next. So what are the big risks on the horizon? Well, it seems like policymakers are already looking ahead. The Reserve Bank of India, the country's central bank, is already predicting that this supercharged growth will cool down a bit. And to get ahead of that, they're widely expected to cut interest rates in December, just to give the economy another little push. And to sum up all the challenges, Deutsche Bank gives us this really handy acronym, TGIF. T is for tariffs, with those big trade negotiations still going on. G is for geopolitics and India's shifting place in the world. I is for investment, that private sector caution we were just talking about. And F is for financial stability. The ever-present risk of some unknown shock hitting the system. So we're left with this story of truly remarkable growth, but one that has some deep complexities under the hood. It's really a tale of domestic strength, pushing back against some serious global headwinds. And all of this leaves us with the big question for the future. With a global slowdown looming on the horizon, will all this targeted government spending and these rate cuts be enough to keep India's economic engine running hot?